Okay, so now let's try to understand about some real world example of the temporary difference. What are they? And then we will see their textbook definition. So we know that there is a company whose name is Amazon and the tax rate is 21%. Now let's see first case where book income is higher or book income gets first and income tax is caused later. Let's see the example wherein you are doing a sales, and as per your books when the sale is recorded you will say sale is recorded on accrual basis. But let's suppose that as per income tax rule or federal taxes, the sale is done on installment basis. Now you may say how it may happen. So it may happen based upon different business scenarios, but I am just creating this example for you for your convenience. So when you say your books will have accrual sales, then let's suppose in current year your books have done a sale of $100,000, but in tax the sale is being recorded on the installment basis, where is the sale is $40,000. So what you will say, in the income tax you are getting this 60,000 which is taxable later. Why? Because you won't show the sales today, and if you won't show the sales today, this 60,000 will be taxable at a later point of time. And if this gets taxed at a later point of time, this will create a deferred tax liability case for us. And on this 60,000, what will be the amount of deferred tax liability? If the tax rate is 21%, you will multiply this 60,000 by 21%, you will get a deferred tax liability of 12,600. Why? Because tax right now is paid lower, and in future you need to pay higher taxes, and that's the reason this is deferred tax liability. The another and easy way I can say for examination for you to identify whether it's a deferred tax assets or liability is again simple. You can just write what is happening as per your books and what is happening as per the tax rule. So you can say that in your books the sale revenue is positive $100,000, but in tax your sale revenue is only $40,000. So what you will say, I need to write something here so that both of these numbers get matched. So what you will write here, you will simply say I will be writing here minus 60,000. So when you write minus 60,000, you will have positive 40,000, and this positive 40,000 will match with the tax positive 40,000. So this is the minus number, this is the negative sign here, which means that this is deferred tax liability. So from this as well you can easily identify. Let's see the second scenario wherein the case is related to accelerated depreciation for tax. When I say accelerated depreciation means what? In the initial years, what happens? High tax is being incurred. So tax is high as per what? As per income tax. So what you will say, that in your books of accounts the expense of depreciation is 20,000, but in your tax in the initial year the depreciation is higher. So when the depreciation is higher, you need to think very clearly. Then depreciation is higher here, you will get higher expense deduction, and when you will get higher expense deduction, your income will be lower. And if your income is lower today, you need to pay lower taxes today, and if you pay lower taxes today, in future you will have to compensate and pay those higher taxes. So basically these 30,000 difference which is sitting right now, you need to pay this at a later point of time. Why? Because in future these depreciation will reduce and this depreciation will increase. So somehow in future you will need to pay higher taxes. Now you need to create a deferred tax liability here for 30,000 against a tax rate of 21%. That will give a rise of 6,300 deferred tax liability for you. Similarly, you can just, if you want to see this through numbers here, so you can write tax books here and tax here. Now within books, you know that you are showing an expense minus of 20,000, and in the textbooks you are showing an expense of 50,000. Why? Because this is a higher depreciation. Now you need to write something here. So what will happen? So both of these numbers will match. So what you will say, this is minus 20,000. If I write minus 30,000 here, then my overall number will become minus 50,000, and this is minus 30,000, so this will become your deferred tax liability again, because this is a minus number. I hope you understood this case as well. Let's see a third case as well, wherein you can say your book expenses are first and tax expenses later. Basically, I'm talking about the warranty expenses. So as per federal law, I tell you that warranty expense are only deductible in your P&L when they are actually incurred. The actual incurrence is very essential. But what happens in your gap books, you always prepare your financial statement based upon accrual. So you create some provision for warranty. So that provision for warranty hits your P&L. So if we see here, like your warranty expenses as per books is 30,000, which is like in your P&L in books you had shown 30,000 as an expense, and in your tax you have shown no expense. When you show no expense in tax, then you will say my expenses are zero here, then my income will be higher. And when your income is higher in the textbook, your taxes will be higher. It means that you have paid higher taxes today as per tax rule. So if you paid taxes today, that will create an asset for you. So you will simply say the differential of both of them is 30,000, on which the tax rate is 21%, and I will get created a deferred tax asset for today. Now simple, if I want to keep it simple, you can write books here and you can write tax here. And within books, you can show that this is a $30,000 of expense for you. So you wrote it as minus, and within taxes, you can write the tax as zero. Now what you need to write here, so both of these numbers matches. So you will simply say, I need to write plus 30,000 here so that this becomes zero and both of them matches. Now you can simply say that this becomes my deferred tax assets. Why? Because there is a plus sign here. So this is creating a deferred tax assets for you. Let's see the fourth case, wherein we are saying prepaid service revenue received in advance. Now what may happen in your gap books, you always know that your books are prepared based upon what? Accrual concept. So for example, this is your year 1 and this is your year 2, and here at this point of time you received $2,400 as a rent for both of the years. Then what you will say, for my accounting purpose I will record my revenue as $1,200 as rent only, and remaining $1,200 will be my prepaid rent. Why? Because these 2,400 belongs to both the years, right? But as per tax rules, what will happen? Even though you receive something in advance as a rent, this will get taxed. So for tax rules, this 2,400 will itself belong to which year? You will say it will itself belong to year 1. So that's the case wherein the situation arises for this prepaid service revenue. Now what you will say, let's see this example wherein the books are showing cash collected in advance, zero cash collected, and the tax, whatever money you received, you will show that as a tax revenue or tax income, because as per accountancy rule, accounting rules, whatever you receive in advance, that don't become your I can say revenue, that goes to your P&L as a not the P&L, that goes to your balance sheet as a liability. So you simply say that if my books right now there is a zero income, and in tax I have shown 40,000 as income today, then on this higher income there will be higher tax today, and if there is a higher tax today, I will get the benefit of these higher taxes in future. So that will create a deferred tax assets for you on these 40,000 at 21%, which will give 8,400. Or if you want, you can again write like this, wherein you can say these are my books and these are my tax books. As per my books, I have zero revenue, but tax department is treating them as a revenue, so I write that as a positive 40,000. Now what I need to write here, so that both of these numbers matches. So you will say I need to write plus 40,000, so this will become plus 40,000 and both of these numbers will match. So this will give rise to deferred tax assets for me, and this is a deferred tax assets. So there may be other situations as well, but what I'm trying to let you understand, like how you need to identify and check if something is the DTA or DTL. Now let's quickly go through this concept through a textbook trajectory. So we can say there are certain transactions that causes temporary differences. Now these temporary differences arises when the timing of recognition of revenue or expenses differs between gap income and taxable income. Basically there is a timing difference at what point of time you recognize certain income or expenses. We saw multiple examples, just like warranty we recognize expenses immediately, but tax say it's not an expense. So there is a timing difference between both of them, and what happens, these timing differences create a deferred taxes because the difference will reverse in the later point of time. Now there is a deferred tax asset or liability created because these will reverse in a future point of time. How these will reverse? If we see this example uh, of prepaid service, you know that this is the prepaid rent for you now, but in year 2 this will become your rent expense, and in year 1 you got the benefit of entire expense. In year 2 you won't get the benefit of this 1200 prepaid expense. So this is the reversal method. Now how this DTL and DTA is created, you can simply see that in the financial statement income first or in the tax return deduction first. What does this mean? You pay low taxes now and more taxes later. If you pay low tax now and pay more taxes later, then you say you need to create a deferred tax liability because in future you need to pay more taxes. Similarly, there may be cases when you pay more tax now and let me just okay, let me just correct it. Let me just correct my words. Here, if you see, you pay more tax now and less tax later. So right now you are paying more taxes. So what will happen? Those more taxes will give you benefit in the future, so that will create a deferred tax assets for you. Or if you don't want to refer these things, then the simple method I have shown you, that you need to write what is your books income or profit, and then you need to write what is your tax profit. Then the four common pattern basically or examples which we have seen within the CPA examination, which one is a simple case of I can say installment sales. The other case may be contractors accounting, where the method may be percentage of completion versus fully completion. There may be some cases of undistributed dividends as well. So these cases creates a deferred tax liability for you. You need not to mug up these cases, but yeah, you need to be aware about these cases. Okay. Similarly, we have seen a situation of depreciation in above example, wherein the method of depreciation may be different, or there may be different methodology for I can say inventory valuation. Some people uses FIFO, some people uses LIFO, and some people uses rising prices method. So based upon that, there may be creation of deferred tax assets and liability. But at the end, your concept should be very clear that there are some books item, there are some tax item, and finally you need to match up both of them. Similar to those things, there may be cases of prepaid expenses as well, because that will give a difference of cash basis in taxation system. Generally, I tell you, taxation system don't look into the provisioning. They always focus on cash. So that always creates a difference. There may be a difference in the bad debt expenses methodology, like some people make allowances, some people do a direct write-off. So that may create a difference. We had seen the example of warranty expenses as we were going above, and LIFO and FIFO methodology we had already seen. Similar to that, there may be cases of prepaid rent and prepaid interest, prepaid royalties, and so on. So all these examples you need not to be mug up, but you need to think in your mind that how these applies to my deferred tax assets and deferred tax liabilities.